Well, my next guest on the show is someone who has been bullish. He has been consistent with his views. He believes we've got all the makings of a long-term bull market, and if you just simply follow Ridham Desai over the course of last 18 to 24 months, you've made a lot of money. So I'm sure he's very happy with his call, but he continues to believe that the structural bull market is on. Ridham, fantastic to have you back. Thank you for joining us, and thank you on behalf of all our viewers. You've been consistent with your views. You've been consistently bullish, and look at the levels we are staring at.
Hey Nikunj, thank you so much for having me on ET Now, and good morning to you as well as Aisha. So yeah, glad to be back on the show. The market is looking good. I think the basis, and we've been discussing this over the past few months, is that we are in a new profit cycle. And I reckon that corporate profit margins will hit a new peak over the course of the next few quarters. If you take a 3 to 4 year view, then we may end up with a compounding of over 20% on earnings. Some of it is priced in, but the market cannot price all of it in because there's always some amount of uncertainty. So as this profit cycle unfolds, I think we will see higher share prices over the course of the next 3 or 4 years. So that's the basis for why there's such a strong bid on share prices. And the profit cycle is coming from very earnest government action. There was a policy inflection that we saw in September 19 when corporate tax rates were cut. Unfortunately, we got impeded by COVID. Otherwise, profits may have already been significantly higher by now. But through the COVID pandemic, the government continued to assert its desire to lift corporate profits, with an eye to getting the investment cycle back and taking India's growth to trend line. So successive policy changes have happened over the course of the last 18 to 24 months. All of those point to a higher share of profits in GDP, which, by the way, had dropped to all-time lows by 2019. So we're coming out of the troughs, and I think there should be significantly more earnings growth that we could witness over the course of the next few quarters.
Fantastic to hear your opening thoughts. I'm going to come into India specific here. But the most anticipated event, which everybody knows, everybody is talking about, is the Fed tightening. Now, markets, when they know something is going to happen, they tend to price in. So if this is the most anticipated event of 2022 and beyond 2022, why is there so much of discussion every morning? What will Fed do? How will Fed act? What will happen to liquidity? Everybody knows it will happen, but we debate it every morning.
See, Nikunj, you're a very seasoned market observer, and therefore you may hit the nail on the head. The market really doesn't care about things that it already knows. We can continue to debate them. And if the market thinks that it already knows what the Fed is going to do, then what the Fed does will not matter. However, at the moment, we really don't know. We will see how that unfolds. And what I think is at the minimum, it will bring more volatility. Now, see, the Fed exiting from its QE program and raising rates per se is not bearish for equities. What is bearish is if the Fed does not anticipate inflation and falls behind the curve. And so far as the Fed has its nose ahead of inflation, the markets will actually be quite okay. And a template for this is the 03-07 cycle. The Fed raised rates successively quarter after quarter after quarter, but it didn't cause equity share prices to stall. More than a few corrections that came along the way, we continued to get rising share prices. So it's not just what the Fed does, it's whether the Fed has anticipated inflation and has moved at the correct moment. And this is something that we'll only be able to tell in hindsight. So I think the Fed actions will bring volatility. We should be prepared for greater volatility in 2022 compared to 2021. In fact, both realized and implied walls are pretty low relative to history. So it's a very easy thing to call that volatility will be higher. And there's not just the Fed. You said, let's come to India. There are a lot of other things that are happening. There are a slew of state elections that are around the corner. Headline valuations are not low. There is a RBI exit that will happen probably starting next month. So there are a bunch of things that are coming up which may induce more volatility in share prices. We kind of got a window into that in December because if you recall, we've seen a fair bit of yo-yoing of share prices over the past 4 to 6 weeks. And such behavior may actually persist through 2022.
Ridham, when you say that markets are factoring in a little bit of earnings structural cycle, but they are not factoring everything, how are you judging that? Because that perhaps is the most important question, that how much of the good news or how much of the structural earnings recovery is in the price and how much is not in the price?
Hey, that's always a difficult thing to say. I mean, it's a matter of judgment. There's no objective way of assessing that. But the way I look at it is, you see how depressed earnings are. So say plot the 5-year compounded annual growth rate in Sensex earnings or the 10-year growth rate. Now that line is really low. If you normalize that line, so you normalize profit share to GDP, what multiple is the market trading at? And that multiple is actually quite okay relative to history. You know, the multiple almost halves because earnings may double over the next 3-4 years. So, you know, a 3-year out, and I know a lot of people will scoff at this, but, you know, 3-year out, the market is not actually trading at rich valuations. Of course, it still depends on the ability of corporate India to deliver those earnings. And for some reason, if those earnings don't come through, then we'll look back and say, oh, this was a great selling opportunity. But I think we have stuff set up here for the earnings to pan out. So the market is not trading rich if earnings are normal. The fact is that earnings are very depressed relative to history, and which is why it looks on a headline basis that the market is trading at a high P, or in fact even a high price to book, because even the book values are depressed. If earnings are depressed, it means companies have retained lesser earnings, and therefore even the book values are depressed versus history.
How is this earnings cycle different from the previous earnings cycles? The previous earnings cycles were built on a lot of debt. Sectors like power, infrastructure, they were in a sense doing all the heavy lifting. But this time it is different. But I want to understand from you, what is your assessment of what is different?
So see, Nikunj, there will be a Capex cycle. In fact, I think the capital spending that corporate India undertakes over the next 24 months may surprise the market on the upside. We have several new sectors that are in the midst of a Capex cycle or at the throes of a Capex cycle. So let's start with the internet sector. 12-month trailing funding in the internet sector has now crossed 1% of GDP. A staggering $40 billion has gone into funding internet equity. This is more than 3 times the number in the previous 12 months and 3 times larger than any 12-month period that India has seen over the last 10 years. So what do internet companies do? They don't actually stash the cash away on their balance sheet. They spend it. So we're going to see a lot of internet capex. Now, this was not there in the previous cycle. The second is energy transition. Because of India's commitment to the Paris Accord and structural shifts that are anyway happening, there is an energy transition capex that's taking place. So be it hydrogen, be it solar, be it gas, these are new avenues of spending that didn't exist in the previous cycle, and there will be a fair amount of capex in these areas. Take infrastructure, for example. Now, of course, we had an infrastructure capex cycle last time, but I think this time around it will be a whole lot bigger because it's backed by the National Monetization Plan. So I think that the government is going to undertake a much bigger infrastructure capex than the last cycle. So that's also going to come in. Then, of course, you will see, the usual suspects, which is steel, cement, because if you're building more infrastructure, if you're building more energy, a capex, if internet is spending, then you will also need basic materials to come. So I think the texture and the form of the capex cycle is likely to be different from last time, but the scale may be very similar. In the previous peak, we hit about 18% to GDP on private capex spending. Currently, that number is 5. It can triple. And, when capex rises and it's still productive, it actually takes corporate margins higher. So the basis for corporate earnings growth is Capex. Only when Capex starts becoming unproductive is when it actually starts straining corporate profit margins. So think the period of 2009, 2010, when Indian Capex became very unproductive and a lot of projects that were not viable were being funded and were being set up. That's the time when earnings growth started peaking out. We are really far away from that situation. In terms of sectors that contribute to earnings, then I think financials, industrials, and consumer will be at the top of the pack. So there will be some similarities with the previous cycle. It will not be totally dissimilar, but there will be some new actors on the scene that didn't even exist 15 years ago, which will be contributing to the earnings growth.
Ridham mentioned that I'm a seasoned anchor, but I must say that he's a very experienced guest, because every time I'm thinking of a question, he's preempting it and answering it by himself, a question on financials which I wanted to ask. So I'm going to ask you something which I'm sure you've been asked by your clients, which is that we've seen one setback, and one policy setback has been a rollback of the farm bill. So how do you judge that? Because some would say that, look, there are UP elections, and here's a popular, here is where, populism has taken over economics. When you talk to your clients, how are you explaining through this point?
So Nikunj, a lot of investors are not discussing that. I don't think there was conviction out there that the agricultural reforms will pass through smoothly. From the very beginning, there was a lot of political resistance, and therefore I don't think it was baked into share prices. So there's no debate. It's unfortunate. I was very optimistic about the potential that those laws had in taking India's agricultural sector to its next stage. I think it had great power to lift a lot of farmers out of poverty. So it's unfortunate that it's been deferred. Hopefully, someday, somewhere along in the future, we see resurfacing of those laws. But let me come back to the point on financials, because I think I did not make the point fully here. So I'm going to preempt another question that you're going to ask. One of the things that I think may happen in 2022 is that the yield curve may start flattening. Now, the yield curve has been very steep. This is a question that a lot of people have been grappling with. That we're in the midst of a big bull market, and financials have not done well. And I think the reason why the financials have not done well is because we've all gone wrong on the timing of the RBI exit, which is that the RBI has been more dovish than what most people thought. If you go back to the start of 2021, through the course of the year, most people thought that it's the next quarter the RBI is going to hike. The consensus was of the view October, then December, now February. The fact is that the RBI has held on to its dovish position to facilitate higher growth. And as a consequence, financials have struggled, because financials need higher short-term yields to actually make more money. And so relative to other sectors, there is a view that financials are going to lag behind. Now, I think that may change in 2022. The yield curve is going to flatten, in my view, because of two reasons. One is, at the long end, I am expecting that the government will clear the path for the launch of fully accessible route bonds. This is going to be a seminal change in India's capital flow history. It will allow fixed income investors to participate more freely into the bond market. But more importantly, it will lead to the inclusion of India into global bond indices, which India is currently not part of. And that will lead to a massive influx of passive inflows, which will come from bond investors. It will outsize the money that we've seen in the equity markets. They look pretty small compared to what fixed income investors can do. It will build India's yield profile globally. And this is also probably going to reduce the amount of pressure on the banks to fund the government's fiscal deficit. And as a consequence, I think it will crowd in private investments and will probably lead to higher credit growth. At the shorter end, it is quite likely now, increasingly likely, that the RBI lifts rate, if for nothing, just to keep pace with what the Fed is doing. So you can't lag behind the Fed far too much. So that is the yield flattening that you get, which is very bullish for financials. So if there's one thing you want to do in 2022, is back up the truck and buy the banks. Across the board, I think banks will do very well. I think non-banks could also do quite well. And therefore, the whole financial space may be a big outperformer in 2022.
Back up the truck and start buying financials. Ridham loves to use this analogy of how to back up, when to back up the truck and when to start loading it. So we've discussed the balance sheet part, which is NPAs are better, cost of capital will be low. But then there is a technology disruption which is happening, and this will change the fee-based income for a lot of banks, because the fintech rhythm is attacking the distribution chain, the insurance chain. Every fintech in a sense has now become specialized in changing the way of banks get their fee-based income, and that's a large component for banks in terms of their profitability. How do you see that changing and that dynamism impacting large banks which have a retail franchise?
So Nikunj, we have to separate what may happen in 2022 versus the medium to long-term trend. Financials have been the market leaders for several years now. And depending on which index you take, they have a weight between 25 and 40%, which will, I think, reduce in time. And in part, this is to do with newer sectors coming into the index, and also because of relative earnings profiles shifting away from financials. So the medium to long-term call is that financials lose share. Part of the reason is exactly what you talked about. There's disruption happening, and some banks will win, some may not. There may be pressure on earnings. Very hard to actually make those judgment calls today. But overall, we can sense that it's likely to be a lot harder than it has been in the past with respect to fee income. Now, this disruption is not unique to financials. It's happening in many sectors. So at the aggregate level, it does not take down earnings, because somebody loses, somebody gains. So the aggregate earnings, probably go higher, not lower. But within that, I think you get winners and losers. And in this context, another point that I'd like to make is this remains a stock picker's market. It's not a market where I think the headline index will give you the type of return that you got in, say, 2020 and 2021. I think most of the returns will come from alpha, not beta. So it's a stock picker's market, in part because of disruption, in part because of how operating leverage is built up on company balance sheets, how various companies are responding to the environment. So there's a lot of idiosyncrasies that are there, and stock pickers, I think, will do generally much better than they did, say, last year or the year before.
Just to get a simple question again out of the way for benefit of a lot of retail audience, if I say that Ridham with Desai's view for 2022 is that we are in for a year of moderate returns, you're not making a case of no returns or negative returns. I just want to clear the air on this.
Yeah, moderate returns has to be seen in the context of what we got last year. I don't think that is likely to be repeated. And I think especially for small and mid-cap stocks, it's going to be a lot more volatile. The large cap index may probably end up doing better than the small cap index. But underneath the index, there will be a lot of opportunity. So the headline returns are likely to be more modest than we have seen in the trailing 12 months or trailing 18 months.
Ridham, I think this was in 2018 at a Morgan Stanley conference. You said, look, my big idea is that you got to buy anything which is going to be beneficiary of pollution control, whether it was EV or whether it are some of the companies which are essentially going the ESG path. EV has become a popular theme. You're making a mention of EV in your strategy report as well. But do you think somewhere this entire EV has become an hype in an overextended story, more like kahani?
No, Nikunj, I think ESG, let me just move away just specifically from electric vehicles and talk the broader theme of ESG. It's here to stay, whether we agree or disagree. There are a lot of investors who think it's a fad. But the fact is that the developed world, consumers are making conscious choices based on ESG. In the developing world, like India, we're still not doing it bottoms up. It's still coming top down to us. But in the Western hemisphere, there are bottom up choices that consumers are making. So they're looking at the products they're buying. and judging whether they are complying with environment, social, and governance standards that they expect their companies to do. So that is the change that is happening there. In India, it's more top-down. More and more capital is flowing into the ESG bucket. There's a huge debate out there on what exactly is ESG friendly. And that's an evolving debate. I think a lot of things that we think are environmentally and socially friendly or good today may evolve over the next 3-4 years. But the fact is, this capital pool is going to grow in size, and therefore ESG as a theme is not going to go away. Now, within that ESG theme, electric vehicles is a sub-theme. And, there will be areas where things get a little overextended, and some places, there'll be other things that catch up. But the overarching ESG debate is not going to go away. Electric, unfortunately, in India, actually, there's not much electric that you can play. I like the electric supply chain. It's less disruptive and it's more reliable. So all the auto parts that are in the power chain, in the whole automobile construction, there are several things that don't change, irrespective of whether it's an electric vehicle or an ICE engine, right? So those are the companies, I think, that will probably end up being clear winners, while there is disruption happening at the electric versus ICE level.
There are two very interesting themes which at least are new, which I have not read in your previous reports. Defense manufacturing and air travel cycle. Let's talk about both of them. Very interesting themes.
Yeah, defense, I think, is going to continue to be a theme for India as we try and bolster our military prowess. And the difference with the past is that I think there's great focus on indigenization. So India will want to make a lot of its defense equipment at home, and there will be big winners out of that. So we're going to probably end up importing less. Defense imports, by the way, is a huge bill for India, which people don't normally see. They focus on oil because that's very apparent. It's a daily thing. You see oil prices go up and down, and you make your back of the envelope calculations. But defense is an ongoing drain on the exchequer. So that, I think, is one. And the second, you mentioned about air travel. So air travel, did get disrupted in COVID, but I think there's a structural uptrend that's happening. And new capacity is being built. Fares are going to be more competitive. And I think India's affordability is, the average consumer's affordability is rising. So he or she can travel by air more often than not. So I would be structurally optimistic on air travel, at least in terms of volumes. Making money on the companies is a little more tricky. As we know, airlines is not the easiest sector in the world to make money, but I think as a theme, that's certainly worth looking at. And in fact, on this point, Nikunj, consumption overall in the country is actually lifting from the bottom of the pyramid. We're at around $2,000, $2,500 US per capita income. That number, I think, in the next 10 years goes to 4,000. Right now, a third of our income is being spent on roti, kapda, makan, very basic stuff. That number doesn't change. So we continue to spend that much money, but your overall income rises. So there's a huge amount of income that gets available for discretionary consumption. And almost everything in India right now is discretionary. Even sending your kid to school is discretionary for most people in this country. So I think a lot of this discretionary spends will go up. In that, you have air travel, you have painting your house, you have building better homes, you have travel, leisure, sending kids to education, lots of things, accessing the internet, buying better telecom services. So a whole lot of discretionary spending, I think, will be in a secular uptrend over the next 5-10 years.
Ridham, my producer is insisting that we need to take a break, but I've requested for just 2 more questions. So I'll make them very quick. Where are you on this comparison between India and China? India benefited because the Chinese regulations were tightening, they've gone against the internet companies, but that market is also at an low. We saw evidence of some brokerages did come out with this advice that book profits in India, go back to China. Do you see that becoming a trend in 2022 when you speak to your clients?
So, Nikunj, I'm not the expert on China, but Jonathan Garner, who runs the relative view in the EM space, is still a little cautious on China. Chetan, who runs the regional economics view, thinks that China's economic cycle could do better this year than last year. And COVID could be something to watch for because China has a zero COVID policy, and we don't know how many more waves we have to deal with before it's done. And every time there's a wave, it does impede Chinese growth. So I think that's those are the imponderables. But overall, the view I'll have to borrow from Jonathan is that he prefers at the margin India over China. So he's equal weight on India. He did downgrade India on the back of rich valuations late last year, but he's more cautious on China.
Ridham, always great to have you on the show and get in all that insight from you. We'll let you go on that note. Good to speak with you as always.
Thank you.